The Indian economy has been witnessing record-breaking growth post-COVID-19 pandemic. The Reserve Bank of India recently issued a stark warning. The RBI is warning that these increases may not be sustainable if asset prices continue to soar without adequate economic backing. The economy could head towards a bubble. Namaskar friends, myself Deepak Kumar Rath. I welcome you to the digital media of Uday India, and today in India Things I will speak about the yellow fever warning by RBI. Friends, the central bank's concern about record growth and its advisories in a remarkable turn of events. The Indian economy has been witnessing record-breaking growth post-COVID-19 pandemic, driven by combination of factors including resilient domestic consumption, robust exports, and a surge in investments. However, amidst this bullish outlook, the Reserve Bank of India recently issued a stark warning that could temper this optimism. The risk of yellow fever infecting the economy. This metaphorical term is a red flag about the potential overheating of the economy, which, if not managed prudently, could lead to long-term economic challenges. This term, though traditionally associated with a viral disease, has been employed by the RBI to signal concern about an overheated economy, where unchecked growth could lead to imbalances with long-term consequences. In the context of the economy, yellow fever represents a state of excessive euphoria and speculative behavior, where asset prices such as stocks, real estate, and other financial instruments experience unchecked growth without the fundamental support of the underlying economy. Just as a fever indicates a serious health issue, the RBI is signaling that while the current boom may appear to be a sign of healthy economy, it could be masking deeper issues that, if not managed carefully, might result in economic instability. And one of the primary reasons for the RBI's concern is the increasing pressure on inflation. While moderate inflation is typically a byproduct of a growing economy, there is a growing fear that the current pace of economic expansion could lead to a sustained rise in prices beyond the RBI's target inflation range of 2% to 6%. Friends, as inflation rises, it erodes the purchasing power of the population, disproportionately affecting the middle and lower income groups who are more vulnerable to price increases in essential goods such as food, fuel, and housing. Uncontrolled inflation can create significant social and economic challenges, making it difficult for families to afford basic necessities and slowing down the overall momentum of economic growth. Another critical concern is the potential for asset pricing bubbles. As the economy expands, the valuation of assets such as the real estate and stocks has been a sharp rise. However, the RBI is warning that these increases may not be sustainable if asset prices continue to soar without adequate economic backing. The economy could head towards a bubble. When bubbles burst, they often lead to sharp declines in asset values, causing significant losses for investors and shaking confidence in financial markets. The ripple effect can lead to broader economic instability, as seen during the global financial crisis in 2008. The rise in household and corporate debt is another factor contributing to RBI's concerns. With easy access to credit and low interest rates, households and companies alike have been borrowing heavily to finance consumption and expansion. While borrowing is a key driver of economic growth, Excessive reliance on debt can lead to financial fragility. Households that take on too much debt may struggle to meet repayment obligations in the event of economic downturns or shocks. Similarly, corporations with high level of leverage may find themselves in a precarious situation if their revenues do not keep pace with their debt obligations. And this accumulation of debt proposes risks not only to individual borrowers but also to stability of the financial system. India's external vulnerability are also weighing on the RBI's outlook. Much of the country's growth has been supported by robust exports and foreign investment flows, making the economy sensitive to global factors. Now, changes in the global geopolitics landscape, fluctuations in the commodity prices, particularly, or shifts in the monetary policy in major economies such as United States can have significant implications for India's growth trajectory. A sudden increase in global interest rates or an unexpected rise in crude oil prices could result in economic shocks that destabilize India's otherwise strong growth. Moreover, supply chain disruptions have been a growing concern in the context of this record growth. As demand for goods and services rises, supply side constraints fueled by global disruptions and domestic bottlenecks can exacerbate inflammatory pressures. India, like many other nations, has experienced logistical challenges due to geopolitical tensions and issues in global trade. When demand far outpaces supply, the result is of rising prices, shortage of key goods, and increased production costs, all of which add to inflammatory concerns. The mismatch between supply and demand could disrupt economic growth if not addressed. In response to these mounting risks, the RBI has issued a series of advisories that aimed at different stakeholders, and one of the key measures suggested is the tightening of monetary policy to control inflation. By raising the repo rate, the RBI can make borrowing more expensive, thereby curbing excessive credit growth and dampening inflammatory pressures. Although this approach might moderate the pace of economic expansion in the short term, it is seen as an essential to ensure that growth remains sustainable and doesn't lead to long-term instability. In addition to monetary tightening, the RBI has called for greater fiscal prudence from the government. While fiscal stimulus has played a significant role in driving India's growth, the central bank has warned that excessive government borrowing could exacerbate inflation and create unsustainable debt levels. Managing fiscal deficits and ensuring a sustainable debt to GDP ratio will be critical in maintaining macroeconomic stability. Policymakers are urged to strike a balance between stimulating growth and avoiding the pitfalls of unchecked government spending. The RBI has also issued advisories to corporates and households, urging them to exercise caution in their borrowing practices. Companies are encouraged to ensure that their debt level are proportionate to their earnings and cash flow projections. Households who are advised to avoid over leveraging and borrow only within their means. These measures aim to prevent an excessive buildup of debt that could lead to defaults, which in turn could destabilize the banking sector. Financial institutions have been advised to tighten their risk management practices, ensuring that loans are given to borrowers with strong credit profiles and sound financial footing. Recognizing the importance of a resilient banking sector, the RBI has emphasized the need for banks to bolster their capital reserves. With rising debt levels across households and corporations, banks face the risk of an increase in non-performing assets, and by ensuring that banks have adequate capital buffers, the central bank is preparing the financial system to withstand potential shocks that may rise from defaults or market corrections. The health of banking sector is crucial to maintaining the overall stability of the economy, and furthermore, the RBI has addressed India's external vulnerabilities by advocating for a more diversified economic strategy. Reducing dependence on imports, particularly crude oil, and promoting the development of domestic industries are seen as ways to mitigate the impact of global shocks. The central bank has also called for maintaining a healthy level of foreign exchange reserves to buffer the economy against any sudden disruptions in global trade or capital flows. The RBI's yellow fever warning serves as a critical reminder that while India's record growth is impressive, it must be managed with care. Unbridled growth through beneficial in the short term can lead to long-term imbalances that could challenging to rectify. The central bank's advisory stresses the importance of prudent economic management, striking a balance between fostering growth and ensuring that it remains sustainable. For India to continue its path to prosperity, policymakers, business, financial institutions, and households must heed the RBI warnings and work together to maintain stability. In essence, the RBI is not advocating for a halt to growth but is rather cautioning against the risks of an overheated economy. The focus must be on fostering long-term growth that is grounded in strong economic fundamentals rather than chasing short-term gains that could lead to future economic distress. The message is clear. India's growth story is promising, but caution and prudence are essential to ensure that it continues on a stable and sustainable trajectory. That's all for today. Stay tuned with Uday India and subscribe to Uday India. Thank you.